expense account is not given, but we need to use a formula that I will discuss, or a continuous inventory system that I will discuss. New method, computerized method that I will discuss further, or computerized where method. We are so here we will use the formula that I will discuss to make sure that we are able to calculate the value of cost of sales if we are using a periodic inventory systems hourly or based on we are able to track goods as and when they are sold, or as and when they are delivered or ordered from the warehouse to our stores or to our shop or a retailer. It means that this particular method makes it easy for us to able to determine the value of closing stock simply because it is readily available. Now, the question may be, how is it readily available? I will make an example of a supermarket. Whenever you are buying goods at a supermarket, as a cashier is scanning, whether it could be canned food or dairy product or whatever kind of product that you are buying, as and when he or she scans that particular product, the system updates to whatever closing balance that the particular shop had. It says -1 because it has been sold. So it is easily for us to access that application, to access that software system, so that we are able to determine the value of closing stock at any given point of time. Meaning that if we are having 10,000 products, maybe a dairy product or milk to be more specific, and at the end of the business we are having 5,000 units, from 10,000 to 5,000 units, it means that we have sold 5,000 simply because we are using continuous inventory system or a perpetual inventory system. We are able to determine the closing stock at any given point of time through the application of more technologically advanced systems or applications. Stock is recorded as an inventory assets account. So whenever we buy trading stock, you debit an asset and you credit an asset. You debit inventory and you credit bank in the case of a cash purchase. But if we bought goods on credit, you will debit inventory account and credit your creditors control or credit accounts payable, simply because we are using a perpetual inventory systems. Stock is recorded as an asset from the date of purchase. Unlike periodic inventory systems where we use an account called purchases, which is an expense account. So that's the second difference with regards to periodic and perpetual inventory systems. With periodic inventory systems, you record your inventory as an expense account, which is purchases. But with continuous inventory systems, we record your stock as an inventory or trading stock, which is an asset account. A closing balance is readily available at any given point of time. I've discussed that. Balance as per trail balance and balance as per the physical stock count. So whenever you are preparing an income statement using a continuous or perpetual inventory systems, you will always have two balances. You will have a balance of trading stock as per your trail balance. If I'm referring to a balance of trading stock as per trail balance, I'm referring to the balance that was taken from your ledger accounts. From ledger accounts, we prepared what? We prepared the pre-adjustment trail balance. So as and when we are buying stock, trading stock or inventory and selling inventory, we are all from the beginning of the year until the end of the year. So that balance includes purchases of trading stock from the beginning of the year, sales of trading stock at cost price, also returns of trading stock. So all those changes towards our balance from the beginning until the end. And the closing balance at the end of the financial year, we call it a balance as per trial balance, which is found in your pre-adjustment trial balance. And a balance as per the physical stock count is the balance that you will always be given within your adjustments. So in your adjustment, they will tell you that the physical stock count revealed that the closing balance of trading stock is maybe 60,000. So the most reliable balance is the balance as per the physical stock count, because we physically went there and counted this stock one by one per item, and that particular value or that particular amount or that particular value is most reliable compared to the value of trial balance. Because with the value of trial balance, if we didn't notice that there are goods that have been stolen, maybe it was discovered later. So that particular as per trial balance is not reliable. But the actual balance that is reliable is a balance based on the physical stock count. Because it might happen that we are saying we are having 70,000 of trading stock or inventory in our warehouse, not knowing that 5,000 of these goods has been stolen or has been damaged, meaning that we are even taking into account the value of stock that cannot be sold simply because of its condition, of its poor condition. So that is the difference between a balance as per trial balance and a balance as per physical stock count. Cost of sales are always given. You say sales minus cost of sales, you get what? Your gross profit. But with periodic inventory systems, that's not the case. You need to calculate your cost of sales.